invited? Okay, still more people from Turkey even. Okay, cool. So yeah, today the topic is how to analyze stocks the fast way, and because investing, especially value investing, which is the strategy that I'm always sort of promoting, which is the strategy Warren Buffett applies, etc. It takes some time to apply and to analyze companies, and there are a lot of companies out there, so it would be great if you guys had some way to sort of speed that process up while not rushing over things. So making sure that you don't miss great opportunities, and making sure that you don't waste any time on on analyzing crappy companies. So let's see if I can help you guys out today by showing you a way to speed up your process without um, sort of rushing over things. So this is me, the picture you always see everywhere. My name is Nick Kraakman. I'm the founder of ValueSpreadsheet.com, and as I said, I'm very excited to be here. So why are we here? I sort of explained it already. I will show you how to analyze stocks in a very fast way, and I'll even let you guys shout out some stock tickers, and I will analyze them for you on the spot. So that will be fun to see what you guys want me to analyze. But we'll get to that later. So I am from Amsterdam, the Netherlands. It's a beautiful city with many sort of, how do you say it, stereotypes going on. Um, it's not all true. So English is not my native language, so apologies in advance if I happen to ruin some grammar here and there. Um, let's see. Oh yeah, someone is having some issues with the. Um, yeah, John is having some issues with the video. I hope everyone else is doing fine. So John, I will definitely send you a replay. This webinar will be recorded. Everyone will receive a link to it. So if you guys have to leave halfway through or something, you can still re-watch it. So what I was saying, I'm from Amsterdam, so sorry if my English is not always perfect, but I'm doing my best. And I want to make this webinar a bit interactive. I already tried it at the beginning a little bit, so asking you some questions, and then yeah, I'll let you guys, as I said, shout out some ticker symbols later on, and so I can tailor the content to what you want to know, and I hope that's all right with you. So in the coming hour, I'll teach you as much as I possibly can, and after that, I'll show you how you can get more help if you wish. And there will be plenty of room for questions during and after the webinar. But for now, let's just get started. So I want to start with this guy. As you all know, as you all should know, this is Warren Buffett, the world's greatest investor of all time and the third richest man in the world. And he had the following to say: whether we are talking about socks or stocks, I like buying quality merchandise when it is marked down. And this really explains his strategy in a nutshell. So his strategy actually comes down to the following two questions, two key questions of value investing actually. So how well is the business performing? That's the first question you will have to answer. And then the second question you have to answer is how much is the business worth? And I've been studying the strategies of Benjamin Graham, Warren Buffett, Mohnish Pabrai, Philip Fisher, John Templeton, and many other legendary investors for years now. And even though the details of their strategies differ, they all base their decisions on those two key questions. Someone asked, what is the duration of the webinar? It's about an hour, and then afterwards you can ask questions. Okay, cool. So yeah, so these are the two key questions of value investing, and not only Buffett applies this, but many other great investors as well. So this sort of sums up, at least for me, what value investing is all about. You have to answer these two questions for yourself whenever you are looking to invest in a company. So when I first learned about this strategy many years ago, I understood that this systematic approach could be made a bit easier by using Excel spreadsheets. And at some point, I was using about 9 different spreadsheets to analyze stocks, and it took me several hours to retrieve all the data and fill in all the all the data that is required for my analysis into all of these spreadsheets. And this was not only boring and time-consuming, but it was also it opened up the door for data entry mistakes, you know. So if you have to enter data into several spreadsheets and you make one little mistake, you put a comma in the wrong place, all your calculations will be messed up. And if you base your decisions on those calculations, yeah, then you're sort of messing up your entire investment strategy, and you could make some very bad decisions. So I started to look for a way to solve these issues. And so first I merged all the spreadsheets that I was using together into one, and that already saved me a lot of time because I only had to input the data once now. And then I realized, or at least I envisioned, I thought, wow, it would be great if I can draw in this financial data automatically. I mean, now I'm entering it manually, but it would save me even more time if that would sort of, if you just enter the name of the company and then it would just draw in all the data, perform all the calculations. So it was actually during my exam period, and you know, just sort of to distract myself from studying, I started building this and after several sleepless nights of programming, I finally succeeded, and the result was the very first version of Value Spreadsheet. And it turned into a tool which allowed me to analyze stocks in seconds instead of hours, thanks to this automatic data retrieval and smart calculations. So I successfully used this spreadsheet for several years for myself, because I created it for myself, for my own investment strategy, to make it easier for myself to find great companies to invest in. And then I read a book, The 4-Hour Work Week by Tim Ferriss, which I highly recommend to anyone. It's an amazing book, very inspirational. And that sort of got me thinking. I thought, well, maybe if it works so well for me, it might work well for others. So that's when I started adding some features, made it more professional, and built the whole website around it, valuespreadsheet.com. And it has really evolved into a powerful investing tool that anyone can use on any device with an internet connection, because it is powered by Google Documents. And I would now like to show you how the Premium Value Spreadsheet helps me to analyze stocks. And I will first run you through the most important features, and after that you guys can shout some ticker symbols. So let me close the presentation and open up the spreadsheet. So this is what you're seeing now is Google Drive. Google Drive is a tool, an online tool for made by Google. It's totally free. All you need is a free Gmail account, and Value Spreadsheet is built inside of Google Drive. It's almost similar to Excel, but just slightly different. So here it is. I just clicked on the file, and it's now loading. And this is Value Spreadsheet. I'm excited to show you guys this because, you know, I've put so much work into building this, and I'm really happy with the result. And I haven't shown it to you guys in a long time because I sort of lost focus and started putting more emphasis on education, on trying to sort of teach you guys about value investing, about the principles. And so I sort of neglected the spreadsheet, but I just updated it last week to version 3.4. It's now version 3.4. I added some very cool new features, and I'll show you exactly what it can do. So this is the most important page. It's the dashboard. There are a lot of calculations behind this, and it sort of all merges into this dashboard. So this is sort of a summary page, and I will just show you how this thing works, because if I input a different ticker symbol in here, for example Apple, what you see is it says loading, It is now retrieving the data online, performing all the calculations, and what you're seeing now is the result of those calculations. So this is all you have to fill in, literally all you have to fill in, a ticker symbol, and it allows you to analyze US listed companies. And yeah, this is the uh, basic of value spreadsheet. And what you see here is very important. Remember the two questions, right? So how well is the business performing, and how much is the business worth? Well, the score is a fundamental score. So it checks several fundamental criteria important to value investors, because that's really, value investing is really the strategy this spreadsheet is created for, and it assigns a score based on everything you see down here. So it checks all these different factors. It based on the data, it assigns a judgment. So is it good, or is it slightly inconsistent, and it assigns points, and that's how it calculates a score from 0 to 100, and 100 being the best. So this is a very quick way for you to sort of compare companies among each other, you know. So we just saw Bed Bath and Beyond, and this is Apple. You saw the first company had a score of 93, Apple of 84. The score allows you to very quickly compare companies with each other. Um, so Bill asks, where is the spreadsheet pulling the data from? That's a very, very good and very important question, because how reliable is this data? Well, this data is coming from about 3 different sources. So one is Google Finance. Oh, Matt, I'll just answer this question first. But yeah, so one is Google Finance. That is one of the main sources. That's where I get the financial statements from, which you can see on this tab. As you can see, 4 years of income statement, balance sheet data, and cash flow statement data. We also got some data coming in from MSN Money Central. Those are those 10-year. This is, for example, the average price to earning ratio of the last 10 years, the debt to equity ratio of the last 10 years. This is coming from MSN Money Central, and we also got some data coming from Yahoo Finance. So those are the 3 main sources. And Matt asked, why don't I have that new version? Well, I did send out an email to all the premium subscribers with a link to the new version. If you didn't get it, maybe it ended up in your spam folder, just send me an email and I'll send you the link. So the spreadsheet, Bader asks, is it customizable? Well, it's actually highly customizable, and that is the beauty of using a spreadsheet, because there are a lot of financial tools online available, of course, right? So most of them are web-based. For example, if you go to Guru Focus, which is a great website, I absolutely love it, but it is not very customizable. Here, because you're using a spreadsheet, you can literally, as you can see here at the top, this is the formula. You can change it, you can edit it, you can literally change every single thing in this spreadsheet. And also, because some of you might be wondering what these weights are on this scoring table. Well, it's a system I implemented so that it is easy for anyone to customize this spreadsheet to their own um, personal investment strategy. Because, as I said, value investing is my personal strategy, and I have a certain, I think return on equity is, for example, more important than the PEG ratio. You might think differently. That's why I assigned a return on equity a higher weight than the PEG ratio. And what it does, it changes the importance of that ratio in the calculation of the score. So, for example, if you think that the PEG ratio is more important, you can simply assign it a higher score. For example, let's give it a score of 8 and see what happens. You see the score changes from 84 to 74. And that's because more weight is assigned to the PEG ratio, and in this case, the PEG ratio is not so good, so it drags the score down. And this way, you can really customize it to fit your own strategy, because some of you are more um, growth oriented. Some of you are more um, sorry, I'm sort of answering questions in the meantime in the chat. Yeah, so this allows you to really customize the fundamental score, and this whole left area is all about finding what Buffett calls excellent companies. So companies with very strong fundamentals, and that's answers the first question. The first question of value investing: how well is the business performing? That's what you can see on the left. Okay. Second question: how much is a business worth? Well, we have three intrinsic value models here, and as you can see, they give three different estimates. And why is that? Well, that's because the intrinsic value of a company cannot be estimated exactly. It's always an estimate based on several assumptions, and that's the very reason why we use three different valuation models, because that allows you to come up with a range. So now you see the range is between 127 and 165. That's the high and the low and the high score. So you know you can be fairly certain that the value of Apple in this case lies somewhere between those value. Um, let's see. Does it work with Indian stocks, Nilesh? No, it does not. It only works for US listed companies, and the very reason for that is not because I don't want it to work for Indian stocks, but because as I said before, the data is coming from sources like Google Finance, and Google Finance unfortunately does not include financial statement data about Indian companies. And that's the only reason why it doesn't work. Otherwise, if Google Finance decides to cover those stocks, then it's fine. Then it can also work for those companies. But in the meantime, it will only work for U.S. listed companies. So let's see. Is it good for analyzing ETFs, bonds, etc.? No, absolutely not. It's only working for stocks, and also not for there are companies like pink sheets and over-the-counter stocks and ETFs and whatever. They will not work. If you analyze normal US listed companies, NASDAQ, New York Stock Exchange, Amex, this will all work perfectly fine. And um, indicates, oh yeah, Mike says that my class, and he's referring to the value investing bootcamp, indicates that book value should not be relied on. No, but it's not simply that it looks at book value per share in this case, because let's see, we now covered the dashboard a little bit. Let's see what lies behind this dashboard, because these calculations are coming from somewhere, right? So let's look at the analysis tab, for example. What you see here is fundamental analysis. So this spreadsheet, what makes it very unique compared to other products on the market, is that it does not simply retrieve data and calculate some things. No, it actually interprets those calculations for you and those results for you. So it doesn't just tell you, okay, the return on equity for this company is 30.6. No, it also gives you, it interprets that for you and says, well, that is a very healthy return on equity level. So people who don't have that much knowledge or experience yet, this is a great way to learn, because what you can see is that return on equity 30.6, this is good. Why? Because return on equity is consistently high, and which means the company capital is invested profitably. That's what you can see here. And it does so for all the other measures as well. So you just asked about book value, Mike. It's not, what I said in the course was that book value can be sort of misstating the true value of a company. So book value is not a measure of, you can't really use it to value a company. However, the spreadsheet doesn't just look at that. It looks at if the book value is actually stable or increasing. And that's really important, because if book value is decreasing, you can say that the company is destroying value, and that's not what you want. You want to be looking for an increase in book value. This is the tab where we have some graphs, financial graphs, the last 10 years of data. If we look at the book value per share for Apple, which is the company we're looking at right now, you see that it is showing an exponential growth, and now it's sort of slowing down a little bit. Well, preferably you look for a company that keeps on growing exponentially, but Apple is becoming so big that it's becoming really hard for them to do that. But yeah, so it also checks if book value is growing. Yeah, so someone says Google Finance does cover UK stocks. Well, the thing is, as long Google Finance covers also a lot of stocks for which it does only show the price data and does not show the 4 years financial statements. And we do need those financial statements to make the calculations. This is again the tab for financial statements. If we don't have this data, the spreadsheet has nothing to work with. But as I say, I mean, if Google Finance covers the stock and it does show the financial statements data as well, then yeah, it works in a spreadsheet. So what's the main difference between having the free membership spreadsheet versus the premium? Well, the free version, it's very limited, because literally all it does is this, the discounted cash flow, and not even this part, which I added in this new 3.4 version. So in the free, when you subscribe to my mailing list, you get some free spreadsheets and an ebook. I hope you guys enjoy the ebook, by the way, because I really like putting it together, because it covers the 10 best investors in the world, and I think it can really help you guys out. So I hope you like it. And yeah, what you get as well is a discounted cash flow spreadsheet, which is one way to value a business. So actually you get this bit. That's it. You don't get the dashboard, you don't get the fundamental analysis, the other two valuation models, the financial statement data, all the graphs. So it's severely limited, the free version. And let's see, what other questions do we have? Thanks for the clarification. How do you screen stocks to determine companies to analyze? Oh yeah, sure. Let's go into that. Yeah, Tim, indeed. Thanks for pointing that out. In the Value Investing Bootcamp video course, I do cover a whole section on how to find interesting stocks to analyze. I can just quickly show you guys how I usually go about doing that. I usually use I go to finance.google.com, and there on the left you see Stock Screener, and here you have this amazing tool where you can screen for certain criteria. For example, I like to add let's see what we got, return on equity, let's say trailing 12 months. And I want the return on equity to be at least 15%. So I type in 15. And now down here you see it gets limited from 30,000 to 1,650. And you can add more things to that. You can even increase it. Let's say you want a really great return on equity of 20. Now you see it's just 1,100. So you can sort of use this to limit the amount of stocks you're looking at. For example, I really want the current ratio, which I believe is a very important ratio, and Benjamin Graham agrees that it should be around 2 or higher. So we do that, and now you see only 300 stocks left. And you can keep doing this until you have only a few left. And the beauty of having a tool like Value Spreadsheet, which allows you to analyze stocks really quickly, or at least perform the initial screening. You can have a list of, let's say, 30 stocks, and you can run them through this in less than, let's say, half an hour. And because in theory you could analyze one stock every few seconds, and then you can you have a great starting point, right? So you have this list of 30 stocks, and normally if you would go manually analyzing them one by one, it would take you hours and hours and hours. And now you can just quickly run them through. Let's see. For example, here we have Aon. Let's fill it in. See what happens. It's retrieving the data now from Google Finance and all the other places, performing calculations. You see, this is what comes out. Now you see a 7.5 score, and the beauty here is it allows you to be very focused with your research, because some things are good. Well, that's fine. You don't have to waste that much time on that anymore. However, if it says return on equity is inconsistent, you know what to look for. So you can be very focused in your research. For example, if we look what is inconsistent about it, we can look at the graph, and we can see that the return on equity, as you can see, it's going from 10 to 30, back to 10, and it's swinging. It has huge swings in it, and that's what it's warning you for. So it really allows you to quickly analyze all these companies and sort of come up with this, yeah, find these great hidden gems among this mountain of stocks. And if we take a look at another feature that I recently added in this latest release, it's these little orange fields. All the orange fields are fields you can fill in yourself, and these are overrides. And what it means is, as you can see, the intrinsic value models, they differ greatly in this case, because you can only make a reasonable assumption about the value of a company if it is consistently earning money. So they have predictable earnings. In this case, Aon, you just saw the return on equity. It swings all over the place, so it's not very predictable. It's not a stably increasing. So that's why these valuations have such a broad range and are not very accurate. And that's what it says here. It says unreliable, which only means that the difference between the highest, in this case 20, and the lowest, 6, is more than 25%. And it doesn't mean anything. It's just there for you to get this, yeah, to have it in your mind that you need to take a closer look at that you can't just blindly trust these valuations. However, because it takes here the average of these three, and because they differ so much, maybe you think, 6 is way too low. It's probably more between 15 and 20, but it says an average of 13. So if you think, no, it's more likely to be 17, you fill in 17 in the override field, and it uses that value instead. And you saw that this changes. So now it's only undervalued 8%, and if you use the original, see it's undervalued 28%. You see, so you can have influence over some of the input data. Let's see, James says, I don't really like Google Finance because it has stocks that are no longer traded, but they still show up on the search. I personally invest with Charles Schwab and use their stock screener. Yeah, sure, you can use whatever stock screener you like, but I do believe that stock screeners are one of the best ways to make a rational selection of stocks to analyze. Because if you probably noticed on my own blog, I hardly ever name specific stocks. I don't give stock tips, because stock tips sort of, they are based on my judgment, and you should really make your own judgment, right? You do your own due diligence. You learn the tricks of the trade, so you learn how to identify a great company, how to calculate its value, and then you make your own decision. And I don't want to sort of give you stock tips, because that would steer your it would impair your judgment, so to say. So but yeah, use stock screeners. I really like them. So what can we cover? What else can we cover? Yeah, so at the discounted cash flow, you notice this little bit. It's the reverse discounted cash flow. It's something people requested. So the current premium spreadsheet users told me that they would really like to see this incorporated. So I did. Your wish is my command. But yeah, reverse discounted cash flow. It sort of gives you a percentage, because as you see that all the other three models, they give you a value in dollars, and this gives you a percentage, and it's sort of this percentage tells you what the amount of cash flow growth that is currently priced into the stock. So based on the current stock price and based on the value of the cash flows, how much does this current price imply in terms of growth? And so you can see 9 point let's say 9.6% is priced into the current price of Aon, and then you can compare it, for example, with well, here in the inputs tab, this is where most of the or where a lot of the data is coming in. You can see the next 5 years earnings per share growth rate. This is what analysts expect. So analysts expect Aon to grow 17% for the coming 5 years, and there's currently, according to the reverse discount cash flow, 9.6% is priced in, which sounds reasonable, and which means that the stock probably has some upside potential. Let's see. Can a company like Target, for example, have negative intrinsic value? Yeah, the thing is, again, intrinsic value. Okay, I really think this is important to cover. Intrinsic valuations can only be made about the value of a company can only be calculated if the earnings are predictable. If you have a stable, profitable company. If the company is making 10 million one year, losing 20 million, and earning 15 million the year after, how on earth are you going to predict the value of that company? You have no idea what way the earnings will swing next year. And so this, of course, this is when you analyze it manually, a company like that, you can make some assumptions, but this is a mechanical process. This spreadsheet uses programming language, so it's very strict, and it applies, and that's one of the big benefits of using a tool like this, is you take emotions out of the equation, right? Because if you see a company with huge swings in its earnings, you might think, but I really like this company, so it will probably perform better next year. And it's very dangerous to make investment decisions on those feelings. And so what I am trying to say is actually that intrinsic value estimates are only possible if you are looking at a company which is profitable and consistently profitable. So if you look at a target, I can fill it in if you want. Let's just see what happens. Yeah, as we can see, there is something with their discounted cash, with their cash flow. As you can see, these are all a lot of bad things. So let's see what's so bad about it. We'll look at the graph. We see book value is increasing. That's great. Look at the net profit margin. It's just going down the drain. Same with return on equity. If we look at, for example, the statements, and we look at net earnings, we see net income fairly. Oh, net income is fairly stable. Okay. Discounted cash flow. Yeah, so the thing is, again, companies which are healthy, financially strong, you can make inferences about the intrinsic value. If not, you can get these wild swings as you see here. You see that the discounted cash flow is 2 and the PE valuation is 48. I mean, it's just insane. You can't really value those companies. Is it fair to say that I would pass Aon? Well, I mean, you can't. If I look at it quickly, I would say yes, I would pass, because I've seen better companies. For example, the first one we shown, the Bed Bath and Beyond, it scored 93. So I would first look if I can buy this for a cheap price before looking at Aon, you know? And can you modify the reverse discount cash flow, Robert? Yes, you can. You can modify literally every single field in this spreadsheet. Please evaluate Yeah, okay, Keith, I will get to that in a minute. You guys can shout out some stock stickers in a minute. I'll just quickly show you one last thing that I haven't shown you yet. I'll just click through is the PE valuation model, which is also explained in the How to Value Stocks ebook, and the return on equity valuation model, which is also included. And finally, this last one, we haven't seen this one yet, financial health. It's based on a book. A lot of it is based on a book by Hewitt Heiserman. It's called It's Earnings That Count. And you, what he found out, he is a certified accountant, financial analyst, CFA, sorry, and he figured out that he could predict whether companies would go bankrupt or not. And you know, the thing he did was very clever. He said there are certain flaws in the balance sheet as they are reported by companies. So he tried to fix these by creating two new balance sort of financial statements. Sorry, I lost the word there. So he created what he called defensive income statement and enterprising income statement. And you don't have to know what this all means, but what it actually does, the spreadsheet checks accrual profit is sort of the net income as reported by the company. Defensive profits are sort of the free cash flow, and it checks whether these are sort of in line with each other. Because what you see with cases like famous cases like Enron, you see the accrual profit, so the net income, you see it increasing over time. But the defensive profits or the free cash flow is not keeping up. So this is a serious sign of earnings manipulation, and the spreadsheet checks for that, which is very powerful. And another way to sort of, which is often used to determine whether a company is about to go bankrupt, is the Altman set score. And so I also included that in the spreadsheet. So as you can see, it's very complete. It checks the standard important metrics for value investing, so the return on equity, debt to equity, current ratio, things like that. It also checks the financial health to see if the company is in risk of going bankrupt or if there is a risk that management is manipulating earnings. And it's calculating all the intrinsic values. And finally, even interpreting that data for you and presenting it to you in a nice package in the dashboard. So, what else do you want? Okay, let's see. Will Emmanuel, yes, you get a recording. I signed up recently. We'll send the How to Value Stocks ebook. Oh yeah, you'll get it. The How to Value Stocks ebook. You guys will get it. I think in the 7th week after subscribing or something. Yeah, it used to be the first thing you receive when you signed up. But I just noticed that a lot of people had difficulty understanding the concepts explained in there because it sort of requires some initial knowledge about value investing. That's why I decided to postpone it a little bit. You can get it right now on my website, but yeah, it's I can paste the link for you guys if you're interested. Let me just quickly go to my website. Let's quickly get it for you. It's here at the bottom. How to Value Stocks ebook. If you want to know more about that, I'll just, well, there it is. Okay. Okay, guys, so I think it's time for you to give me some ticker symbols. I already see, let's see, who was the first one? SPCB by Key. Let's do that first. Okay, so again, it's loading the data. Super calm. Okay, cool. Very strange results with the valuation. We see that the PE ratio is not that good. You see the financial health, the accrual profit, defensive profit are all sort of in the negative range. So let's see what's happening there. So they made a loss for those 2 years. Now they are recovering. They are definitely recovering, but they are not generating any free cash flow at this moment. It's all negative. Um, So that's not great. Um, that's why it's showing such a relatively low score. If we look at the PE valuation -1, it's yeah. The thing is, it takes the median historical price earnings ratio and it takes it from the 10 years of data, which is coming in here. And as you can see, it had negative price earnings for those years. So that's why and that's why I included this override function here, because maybe a more reasonable thing, PE ratio would be 12. If we do that, you see the PE valuation changes accordingly. So yeah, but I would probably stay away from this one because it hasn't shown um, consistent profitability yet. Maybe it will in the future, but for now I would stay away from it. Okay, let's see. MNKD by James. Founding Mankind Corporate biotechnology is always scary, at least for me. I mean, if you're all knowledgeable about uh, biotech, please go ahead. But I don't get it. It's too complicated for me. I mean, yeah, only making a loss. Sure, that's a different style of investing. If you're interested in companies like this, you are thinking, hoping, praying that their new biotech product will hit the market and will be a huge success, and they will become extremely profitable from one day to the next. That's not how I approach value investing. I want only to invest in companies which are consistently profitable, and this company obviously is not. So I would stay away from it personally. Um, let's see, Microsoft. That's one, because I actually just sold some of my Microsoft. Yeah. So what we see is actually a fairly healthy company. I mean, 7.8 or 78 is a good score, and especially because some of these might not be as bad as the score makes them out to be. So the net margin, if we take a look at the graph, see what happens to the net margin. You see book value is just skyrocketing. They're doing pretty good, but the net margin is going down. So, or at least fluctuating a little bit between 24 and 28, which is not too bad because the net profit margin of 24 is actually pretty good. You know, their return on equity is still solidly above 20, even though it's declining. So with Microsoft, I would say don't just blindly uh, base. Um, sorry, don't just look at this and think, net margin is crap. No, just it only indicates that you should take a look at it more closely and see why is it saying that it's bad. Well, it's saying that it's bad because it's declining. And if you have reason to believe that this is only temporary and not a long-term negative downward trend, then yeah, Microsoft might be a great buy. Regarding valuation, it's sort of fairly valued in my opinion. I think personally, I believe it's closer to 60 the value than to the other ones. So let's say maybe a score of 50. That means that it's undervalued 13%, which is not that great. That's why I decided to sell and put my money into something else. Um, let's see. Yeah, I can't do them all, guys. I'm sorry because we're running sort of near the end already. But I'll just input some. I mean, someone asked me to input Netflix, James. Uh, hmm, okay. I'll just quickly go past this one because, as you can see, a score of 47. There's not much to win there. Uh, Azo. Someone says Azo. Sammy. Okay. Yeah, it doesn't look too pretty. Book value per share. No, stay away from this company. Stay far away from it. NYGN by Ben. Let's quickly do a couple more and then genetics. I see something. Genetics. Wow, this is pretty good. This is pretty interesting. Okay, what we see here is again a very high score here, which is great, but the net margin is again it says bad. So let's see why. Book value skyrocketing, very nice. Ah, it's fluctuating. You know, it showed a dip here, so that's why it says that it's not so good. But actually, it's pretty good. Very interesting company. Okay, I'll remember this one. I'll write it down and then take a closer look at it later. Um, it's even undervalued at this moment. So one more thing I would like to say. It says max purchase price here, right? So what this means is on the inputs tab, you have several inputs you can adjust yourself. So your desired return on investment annually, your margin of safety, the discount rate, the growth decline rate, because as companies grow bigger, it becomes harder for them to grow. So the growth declines, and these are all things that go into several of the calculations. But here, this one is interesting for now. Desired return on investment, 20%. That's what I input. Now, if we look at the dashboard, it says that the average estimate is 48. The intrinsic value is around 48. That's the average estimate. Now, if that is true, and I want a 20% return annually, compounded annual return, what price should I decide to buy? Well, here, that's what you see here. So if I purchase below this 29.66, and this is the value of the company, it means that in the coming years I will be able probably to earn a 20% annual compounded return, which is amazing. So at this point, the current share price is 36, so it's not quite there yet. If I purchase at this price, I can still make a profit, but I will probably make less than the 20% I desire. So this is a very interesting figure. I'll do one more. Let's see. Yeah, I have to. I'll just pick one. Emmanuel. Let's see. This is the last one. As you can see, all the companies so far have worked. So I hope this one. Okay, gives a very strange DCF. Let's see what's going on there. It's because the free cash flow is negative. Yeah, so if the free cash flow is negative, this can't work, obviously. It can't predict how much free cash flow it will generate in the future because, oh well. So that's one of the companies that I've been talking about lately. Okay, and I'll see if I can answer some of your question. What percentage of being undervalued do you look for as a starting point? Well, as I just told you guys, I input 20% a year. That's what I want to earn at least. Then I look at the max purchase price, and if I can purchase below that, then it's great. I'll get in, and otherwise I wait. And in this case, you see the DCF is sort of screwing things up, and that's because if you take a look at their female health core, they had huge capital expenditures this particular year, and that's what's skewing the discounted cash flow. But in general, you can say that it's probably worth around $8, which means